There are a lot of approaches to investing for retirement, including even in the dividend space. Of course, there are those who advocate for simply investing in a low-cost index fund like the S&P 500, with ETFs like SPY and VOO out there that are really popular for that. And the theory there is you're well diversified, you don't have to worry about any stock picking, you paying out minimal fees, and you could just dollar cost average into those funds every month over the long term, and you're going to end up with a pretty solid compounding effect. You'll end up with a portfolio that you want to have that's 25 times your estimated monthly income expenses, and then you'll end up with a portfolio that's roughly 25 times your estimated monthly expenses. Then you just take out 4% every year, and you should be able to live for the long term, at least over that. Of course, the problem with that is you run a lot of risk of sequence of returns. What if the market crashes and then goes through a lost decade? You're going to end up cannibalizing your portfolio a lot faster than you would have previously thought possible, so you could be in a lot of trouble. The S&P 500 is increasingly concentrated, over a third of it's concentrated in these mega cap tech stocks that are tied to the AI boom. So what if the AI boom disappoints, even in terms of profitability or the scope of it? Maybe the expectations for technology are not as great, or maybe these mega cap stocks end up being big losers and there are other disruptors that come on the scene and outperform them. What then? Or maybe they're just overvalued and they're going to underperform moving forward. Well, then you're going to have a big impact on your performance of your portfolio over time. And so maybe the S&P 500 isn't as well diversified as you previously thought. So then there are other approaches. Sure, you can invest in real estate, private real estate. Well, that's great. You can get high yields, especially previously. Now it's not so great because interest rates are high. You have to pay pretty much cash on properties or do a lot of effort to fix and flip to be able to extract cash flows. But even if you can buy properties that you can leverage up and get a good cash yield on, you're still effectively buying yourself a business, because landlording is not passive. It is an active undertaking. So again, not saying that won't work, but again, you're going to have pretty big concentration risk in properties and geographies, most likely, unless you're really rich, and you're basically buying yourself a business where you're going to have to put in a lot of work over time, especially in certain spurts. And for many, that's not their thing. They want to spend their golden years, their retirement, doing other things. And so there's another approach, and that's dividend investing. Now that's popular too, because it's like the first option, but has one extra advantage in that the cash flows from your dividends cover your living expenses instead of you cannibalizing your portfolio over time. And dividends tend to be much more stable, especially if from a diversified blue chip portfolio. They tend to be much more stable over time than stock market price performance. So you reduce that sequence of returns risk while still retaining the passivity. You can invest through a well-diversified fund like the Schwab US Dividend Equity ETF. That's a very popular one. There's some created by Vanguard that are pretty good, and some others out there. But SCHD is considered the gold standard for these types of things. And you could supplement it, of course, with an MLP ETF, a REIT ETF, utilities ETF. There's some infrastructure CEFs and ETFs you can invest in. Maybe even a couple blue chip stocks that you like Realty Income or Enterprise Products Partners or something like that. And so that's one way to do it. And I subscribe to that view. I think it's a great way to retire. However, I don't think that is enough, especially in the world we're in today. And so in today's video, I'm going to discuss more about the 2 investments you need to retire. Before I get into the rest of the video though, if you like this sort of content, you like learning about dividend investing, how that can set you up for early retirement, or simply just help you compound wealth reliably and at very attractive rates over the long term, please subscribe to my channel for more videos like this, and also like this one to help it reach a larger audience. I would greatly appreciate it if you could do that for me. Thank you very much. Okay, so what are these 2 investments? Well, the first one I've already basically given away to you. That's diversified portfolio of dividend stocks, especially blue chip ones that grow their payouts over time. And really, I look for 4 main requirements in these sort of companies. First, has to be a durable and defensive business model. Can't be one that's going to get blown up in the next recession or economic crash, or can't be one that's highly susceptible to disruption by AI or some other major technology innovation. At the same time, it also has to have a very strong balance sheet. You want a balance sheet that's not going to force the management to choose between the dividend or the balance sheet at a certain point in the future. And sure, future events are unpredictable. These things can blow up in your face, but to the best of your ability, find ones that, at least from what you can tell today, their balance sheet's in good shape, and that it's going to take a severe black swan type event to the company to blow up the balance sheet. And to protect against that further, you could just diversify. That's my point at the beginning. So what's the third thing? Well, you want it to have a yield that is durable, and likely not just durable in the sense of the raw dollar amount not getting cut, but also be able to withstand the erosive power of inflation over the long term. So in other words, you don't just want a payout that's going to come in reliably, although of course you want that. You also want it to be able to increase at a rate that meets or beats inflation over time. So really at least a 3-point baseline growth rate to keep up with inflation to sustain your purchasing power. Now you can get that through two ways. One is organic growth, namely dividend growth from the fund itself or the stock itself. Does it have a track record? Is it likely going to continue growing at least a 3% pace per year? But the second thing is, if not, does it have a high enough yield that you could reinvest the excess of that yield to what you need to generate from it to support your living expenses, to buy more shares of that or some other investment that can generate additional income to still grow your total income by at least 3% per year? So again, that's something to consider. And really, in aggregate in your portfolio, you want to target above a 3% growth rate, probably a 4 or 5%, to make up for years where inflation's a bit elevated, as well as periods where maybe some of your dividends get cut in your portfolio due to black swan events or economic downturns, because you're not going to get all your picks right. And so that's really some things to keep in mind. So the fourth thing you want to look for in these stocks is a high enough current yield. You want to have a high enough yield that based on your money that you think you're going to have saved for retirement, you can adequately support your living expenses. So again, if you want to do the 4% rule, you need to have at least a 4% yield. Although again, I advocate for a little bit higher, just as a cushion in case expenses go up higher than you expect. You have a near-term expense you didn't expect. You have a dividend cut that you didn't expect. And worst case scenario, you don't need any of that, or I should say best case scenario, and you have that extra income that you can then just use to buy more shares or give to a cause you care about or take an extra trip or whatever it is. And so that's how I would build my portfolio of dividend stocks. A great way to start, as I mentioned, is with a broadly diversified ETF that has a proven track record, that has blue chip holdings, good dividend growth. SCHD is a great choice for this. It has around a 4% yield at the moment, so you get that 4% rule working for you. Over the past decade, it's grown its dividend at an 11% CAGR on a per share basis, which is incredible. I wouldn't expect it to continue that moving forward. Probably, I would say maybe the high single digits rate moving forward is more feasible. That's still really good. So I think SCHD, with its low 0.06% expense ratio, diversified across over 100 blue chip dividend growth stocks across many industries, I think it's a good place to start. And you could supplement it again with MLPs, either through an ETF like MLPA or AMLP, or individual midstreams, whether it be Enterprise Products Partners, Energy Transfer, MPLX, Enbridge, TC Energy, Williams Companies, and the list goes on depending on if you want. Kinder Morgan's another one, although I don't love that one because the dividend growth is too slow. But again, it could either be a midstream infrastructure with issues as a C Corp, issues a 1099 tax form that may be more appealing to your situation, or you can get from a K1 issuer that has certainly tax advantages to it. But again, you got to deal with the K1. So whatever one fits you, but you can supplement SCHD with REITs too. It doesn't have much in the way of REITs. Realty Income is a great option. NNN REIT, Essential Properties, Realty Trust. There are a bunch out there that you can or you can just invest in like VNQ or RQI or RNP or PFFR. Those are all REIT funds that pay pretty attractive dividends. Utilities, same thing. You got XLU, which is the standard utility ETF. That's low cost. You can go with the CEF route with funds like UTG or UTF that have a little bit higher yields and more broadly diversified portfolios into even some other infrastructure businesses. Of course, the Brookfield infrastructure holdings like Brookfield Infrastructure Partners or Brookfield Infrastructure Corporation, Brookfield Renewable Partners, Brookfield Renewable Corporation, those are great options as well. So there are many ways you can build that dividend growth portfolio. You can just go all individual stocks, which is what I do at High Yield Investor. You can check out my portfolio through the link in the video description if you're interested. You can also supplement further with real estate backed loans that yield 10% or even higher in some cases. You can see that at Ground Floor. Again, there's a link in the video description. If you want to see it, you get a $50 free investment credit if you sign up through that link. So feel free to check it out. But then the second investment that I do is precious metals, especially gold. And why do I think that that's so essential for a retiree? After all, gold doesn't generate a yield, does it? Well, it actually does. There's a way to do that, and I'm going to talk about that in a second. But I also think gold is essential right now because we are in very uncertain times. In fact, if you look at what's happened with the price of gold over the past couple of years, it's shot higher. And there's a reason for that. We had runaway inflation for several years coming out of COVID-19 lockdowns. It was really both parties were responsible for this. The Republicans under Trump and their Congress sent out these massive bailout packages during COVID. Now, they argue these were needed to preserve the economy. Okay, that's a separate debate for a separate video. But even if you say that they are needed, there's still a huge consequence. You had all this helicopter money dropped on the economy, and a lot of goods were not produced or delivered on time because of supply chain issues, lockdowns, etc. And so you had a lot more money chasing fewer goods. What are you going to get? Inflation. So no surprise there. But that inflation then drove interest rates higher, which in turn have caused some disruption to the economy. And now gold is boosted by, first of all, the Fed did pivot to some rate cuts, which is a tailwind for gold because it competes with cash and the interest rate you can earn on cash in a savings account for as a store of value. And so the falling rates made gold comparatively more attractive. But there's been more here. The runaway deficit spending by the government for these bailouts and other programs has caused the market to grow increasingly concerned about the sustainability of the U.S. fiscal situation, the budget, the soundness of the U.S. dollar. Additionally, Russia's invasion of Ukraine with the sanctions that were put on them also caused some flight from the dollar because Russia's assets in euros and dollars were frozen as part of the sanctions put on them. And so that made a lot of other countries who may not be really close to the U.S. or potentially could be at odds with them in the future think, hey, if I have some of my national wealth, some of my reserved in dollars, those could be sanctioned too. And so now they're looking to gold as a popular option. In fact, we've seen central banks in recent years buy gold much more aggressively than they had in the past. China has been spearheading that, but there have been other banks doing the same thing. And so that's been another driver for gold prices higher. Also, Chinese middle class has been losing a lot of confidence in their own stock market and in their property sector, which were previously hot investment classes for them. But because of government crackdowns during COVID and the real estate bubble bursting and the government interfering in companies like Alibaba in recent years because of their leader Jack Ma spoke out against the government, that's caused their stock prices to go down, their real estate prices to go down. So they've been increasingly disillusioned, the Chinese middle class, and said they've been buying gold as an alternative investment. So that's also pushed prices higher. And so and even in the US now, gold is growing in popularity as concerns about geopolitical events around the world are growing, concerns about tariff uncertainty and many other things driving gold prices higher. And so we're still in a very uncertain world. The deficits don't appear to be going down anytime soon. Trump's big, beautiful bill is actually exploding the deficit, not reducing it. It seems like the war in Ukraine is not going to end at any time soon. There's threat for war in the Middle East. Threat for war in the Far East is very high as China is increasingly getting assertive around Taiwan, and the military balance in that region is increasingly unfavorable to Taiwan and to the cause of peace. And so for those reasons, I think it's really prudent that a retiree has gold. And there have been studies by groups like the Rand Corporation, et cetera, that if China were to invade Taiwan because of Taiwan's centrality to the global supply chain, especially for semiconductors and the AI boom, it would likely cause massive destruction of wealth around the world, especially in the US and China, plunge the world into a depression, especially the US and China, and therefore the stock market would likely crash. There'd likely be some dividend cuts, potentially some very painful ones. And so you want to have your dividend income stream protected by gold, because gold will likely soar in such a scenario, and then you can use that to fund your living expenses or to buy more dividend stocks on the cheap, just depending on the scenarios and the exact options available to you at the time. So that's why I think gold's important, because even in environments where gold doesn't do well, let's say the dollar gets on more sound footing and China doesn't invade Taiwan, the AI boom explodes, the world is prosperous, tariff situation is worked through, gold declines. Well, in those scenarios, interest rates likely fall, dividend stocks boom, they grow, their payouts grow, and you're fine. In environments where the dollar collapses and your dividends become worthless, or they get cut, or there's a war, a major war, again, dividend cuts, dividend stocks crash, gold goes up. And so you have that nice built-in hedge, and that's the reason why I think gold is so important. But lastly, I'll just mention real quick, you can even earn a yield from gold. You can do that through several means. One is some of your gold portfolio could be in dividend-paying gold mining stocks or gold streaming stocks. There are a lot out there that pay nice dividends, that grow their dividends over time potentially, and you can get some cash flow from that to supplement your dividend income stream. It won't be big, but it'll be something. You can also invest in, there's some ETNs in gold and silver, as well as simply just sell your own options against gold ETFs. That can help you generate some income as well. I don't, again, recommend overdoing that, because you want to have that upside potential in the event things go haywire from your gold position. But my favorite way to generate yields from gold is from a company called Monetary Metals. You can buy bullion there, and then they pay you, for example, if you buy gold there, they pay you 4% interest rate on that gold, because they lease it out to jewelers and other companies that want to lease the gold to hedge their commodity exposure. And so there you go. You can get a nice 4% yield along with unlimited upside from the gold, no storage fees, no insurance or anything like that. They make money by being the middleman, and so they do collect a fee from the leasers of the metal, as well as a slight spread. Maybe the lease is for 5% and you get 4% of it. They capture the 1%, something like that. And so they are collecting fees to be profitable and sustainable. But as an investor, these leases are very low risk. They've never had any loss of principal or interest on them since launching about half a decade ago. It's all fully insured. The metal's fully insured and accounted for and tracked. And so it's actually a relatively low risk way to earn a pretty nice yield on your gold. So it's effectively a gold savings account, CD. 1-year CD usually is how long these leases are, and then they renew over time. And so you get a nice yield that's like having a CD, plus you get the full upside potential of gold bullion, or they also do silver as well. So again, hopefully that was helpful to you. If you're interested in monetary metals, I have a link again in the video description. You can click on that and learn all about it. If you have any questions about it, feel free to let me know in the comments below. But otherwise, thank you so much for watching. And again, if you liked it, please give it a like. Subscribe to my channel for more ideas like this in the future. See you next time.